Netflix stock is down 15% after earnings. No guidance raise, slowing international growth, and the Warner Bros. Acquisition they were chasing is gone. So is this the beginning of the end for the world's largest streaming platform? Or is the market completely overreacting to a business that's still compounding at an impressive rate? I'm Edward Galstian, founder of Egg Capital, where we look for market-beating stocks for the long run. Today, we're breaking down Netflix using our 5 key factors: economic moat, return on capital, growth, financial strength, and valuation. Let's get into it. The moat is always our starting point, because if a company can't protect its profits from competition, everything else becomes irrelevant. Netflix's moat is rated narrow by Morningstar, and I think that's the right call, but let me explain exactly why. First, no legacy baggage. Netflix built its streaming business from scratch, with no declining cable network, no expensive sports contracts, and no traditional media empire to manage. While Disney, Warner, and Comcast are all stuck juggling legacy businesses that are slowly dying, Netflix gets to put 100% of its energy into its core streaming product. That's a massive strategic advantage. Second is the virtuous cycle. Netflix has over 300 million subscribers globally, the largest base of any streaming service by a wide margin. And here's what makes that so powerful. It funds a massive content budget, nearly $20 billion in 2026, which attracts more subscribers, which generates more cash, which funds more content. This flywheel has been spinning for over a decade. But here's the nuance. Netflix's moat is narrow, not wide, and that matters for long-term investors. Because unlike Microsoft's switching costs and Alphabet's network effect, Netflix's moat depends on continuous execution. They need to keep producing hits, keep pricing at levels consumers are willing to pay, and keep growing internationally. 1 or 2 years of content misses and subscribers can leave. The bears will argue that competition has never been fiercer. Disney+, HBO Max, Apple TV, and Amazon Prime. And they're right that consumers are making active choices about which subscriptions to keep. But Netflix's answer is data. Their recommendation algorithm knows what 300 million people want to watch better than any competitor, and that data advantage compounds every year. The bottom line, Netflix is the only pure-play streaming company in the world with a moat. Disney has a wide moat, but it's based on IP and theme parks, not streaming. Warner Bros. Discovery has no moat at all. Netflix stands alone here. Now, the moat analysis you just saw, I pulled it directly from Fiscal. It's the platform I use for analyzing all 5 key factors. If you want to follow along with the same tools, the link in the comments includes a 15% discount. Returns on capital tell us how efficiently management converts investor dollars into pure profit. This is one of my favorite indicators of business quality. Netflix's return on invested capital is 27.6%. And what makes this even more impressive is the trajectory. The trend is moving upward, even though the usual perception is that Netflix is burning cash on new content. It's still generating exceptional returns. Let's compare that to peers. Alphabet sit at 33.4%, which is exceptional. Disney is at 8.6%, struggling, weighed down by legacy assets. And Warner Bros. Discovery is at 0.4%, essentially destroying value and trending down. Now on to return on equity, which measures how much profit shareholders are getting per dollar of equity. Netflix sits at 42.8%, which is genuinely impressive. Alphabet at 35.7%, Disney at 12.2%, and Warner Bros. Discovery is at 2.1% and declining. Netflix sits at the top of this group on return on equity. And when you add in the share buyback program, which was $9.1 billion in 2025 alone, that return on equity number gets even more powerful because the equity base is shrinking while profits are growing. The return on capital story for Netflix is one of the best in this peer group. Disney and Warner are miles behind. Growth is the engine that drives long-term value creation. Without it, even a multi-business eventually stalls. Over the last decade, revenue grew at a compounded annual growth rate of 19.9% and net income grew at a CAGR of 57.2%. Earnings per share has been growing at a CAGR of 57.2% as well. That earnings per share growth is extraordinary. The main driver behind this is margin expansion. As Netflix scaled, they've gone from single-digit operating margins to 29.5% in 2025. Now the critical question, can this growth continue? And here's where we need to be honest with ourselves. The US market is mature. Netflix already has a very high household penetration in the US and Canada. Future US growth will largely come from price increases, and the March 2026 hike, which came just 14 months after the previous one and exceeded 10%, raised the real question: how often can they do this before subscribers start canceling? The growth engine going forward is international markets, EMEA, Latin America, and especially APAC, where India is expected to drive double-digit subscriber growth through 2030. Morningstar projects 10% average revenue growth through 2030, a meaningful step down from the historical 19.9%, but still respectable for a company of this scale. Long-term analyst earnings per share growth estimates sit at 21.4%, which is honestly solid. That reflects continued margin expansion, stock buybacks, and international monetization picking up. But it's no longer the hyper-growth story of the last decade. The growth narrative has shifted from subscriber explosion to monetization discipline. That's a more mature, but still attractive compounding story. Financial strength is our sleep at night factor. Can Netflix survive a storm and keep investing during a downturn? Netflix's numbers here are solid. Total cash and cash equivalents sit at $9.1 billion and total debt at $14.5 billion. Total free cash flow sits at $9.5 billion, and this gives us a free cash flow to total debt ratio of 65%, meaning Netflix generates enough free cash flow to pay off its entire debt in roughly 1.5 years. Anything above 10% is considered healthy, so Netflix is in a very comfortable position here. The debt-to-equity ratio has been on a consistent downtrend, from 2 in 2018 down to 0.5 in 2025. For context, a debt-to-equity below 1 is generally considered conservative for a large-cap company. Below 0.5 is strong. Netflix is essentially at the border of that healthy range and moving in the right direction. Now compare this to Warner Bros. Discovery, which is drowning in debt from the Discovery merger. Their balance sheet is genuinely concerning. Disney carries significant leverage too. Netflix looks like the financially disciplined player in this group. One thing worth watching, Netflix is spending nearly $20 billion on content annually, and that's expected to grow. The discipline of management here, staying out of expensive live sports rights, avoiding splashy M&A, is what's kept the balance sheet clean. The decision to walk away from the Warner Bros. Acquisition also earned them a $2.8 billion termination fee, which is just exceptional capital discipline. Even the best business can be a terrible investment if you overpay. Valuation is the final filter for our margin of safety. Netflix's forward price to earnings is 28. Now let's put that in historical context. The lowest forward PE since 2017 was 15.7, the highest was 144.8, and the historical median was 50.6. At 28, Netflix is trading well below its historical median. Now compared to peers, Alphabet trades at a forward PE of 29, which is essentially on par with Netflix. Disney trades at 15.1, the cheapest in the group. And Warner Bros. Discovery is negative, which is not meaningful due to expected earnings declines. Netflix is trading at a slight discount to Alphabet on a forward PE basis, which is interesting given Alphabet's wider moat. Now let's go deeper with the price to earnings growth ratio, because the forward PE alone doesn't account for growth. The forward PE of 28 divided by the long-term earnings per share growth estimate of 21.4% gives us a PEG ratio of 1.3. A PEG ratio below 1 is undervalued, 1 to 1.5 is fair for quality companies, and above 1 is expensive. At 1.3, Netflix sits in fair territory, not cheap, but for a company with this moat and this return profile, not unreasonable either. Let's bring this together through our 5 key factors. Netflix has a narrow moat, the only streaming company in the world that owns one. Returns on capital are elite, with 27.6% return on invested capital and 42.8% return on equity, and both improving. Growth is decelerating from extraordinary to strong, but 21.4% projected earnings per share growth is still a compelling compounding profile. The balance sheet is clean, with a 65% free cash flow to total debt ratio. At a forward PE of 28 and a PAG ratio of 1.3, Netflix is a high-quality compounder trading at fair value. The market punishes it every time growth wobbles. What do you think? Is this 15% drop a buying opportunity or the start of something bigger? Drop your answer in the comments. If you found this analysis useful, make sure you subscribe. And check out Fiscal.ai in the description to run these numbers yourself.